Dear students of ninth class, Assalamu alaikum. Today we are continuing yesterday's topic, that was the exercise of the chapter Money and Banking. We discussed some of the solutions of different questions, and yet the various questions are to be discussed. It is a question where where we reached in this yesterday's video. It is, why can one not refuse a payment made in rupees in India? Why is one not able to refuse the payment made in rupees in India? You can see the answer. In India, one cannot refuse a payment made in rupees because by law, the Reserve Bank of India issues currency notes on behalf of the central government. Central government issues this paper note as a rupee, which is done by the Reserve Bank of India. Okay, the law legalizes the use of rupees as a medium of payment which cannot be refused in settling transactions in India. That means nobody is able to refuse this currency, this rupee note, because it is authorized by the central government, by the Reserve Bank of India. Okay, this is a law. Okay, now the question here, the second question we have to discuss today, it is, why are the deposits in the bank account called deposits? Why the money which we deposited in our banks is called a deposit? Here the answer is, these deposits are made to deposit accounts such as saving accounts, checking accounts, and money market accounts. Okay, these deposits are done in these accounts. The account holder has a right. The account holder, the account holder, the man having that very account has a right to withdraw deposit funds as set forth in the terms and conditions governing the account agreement. That's why the money deposit in the banks are called deposits. And now the question we are going to discuss, it is, how do banks mediate between those who have surplus money and those who are in need of the money? The two persons, the person having money in surplus more than his need, okay, and the person who hasn't money even to settle his needs. Okay, why the banks are mediating between the two? Banks use this. Here you can see the solution. Banks use the major portion of deposits with them to extend loans to people who need money. There is a huge demand for loans for various economic activities. In this way, banks mediate between those who have surplus funds and those who are in need of funds. The people having bulk of money, having surplus money, having money more than their needs, they deposit their money in the bank, they save their money in the bank, they prevent their money in the bank from thieves, etc. Okay, and that very money is used by the people who are in need of the money, who wants to do business, who wants to meet their needs, who wants to build a house, who wants to buy a car. That money is used by these people. So in this way, the banks are mediating between the people. Here the question is, what's a check? What is called a check किसको बोलते हैं? Check, what is a check? This is a check. You can define it as, check is an important negotiable instrument. Okay, negotiable means it has been negotiable. It is negotiable between the bank and the depositor, which can be transferred by mere hand delivery. Okay, hand delivery, you can transfer it, hand deliveries. Anybody can come with this very document to the bank, and this bank can give the cash which is written on this check. Okay, check is used to make safe and convenient payment. It is less risky and the danger of loss is minimum. Okay, now the question here, it is, what's a loan? A loan is a sum of money that one or more individuals or companies borrow from banks or other financial institutions Post office is also an example. So as to financially manage planned or unplanned events. In doing so, the borrower incur a debt which he has to pay back with interest and within a given period of time. Okay, what's a loan? Loan is the money which the bank is giving to the people who are in need of the bank, and they have to repay this loan with the interest, with a fixed amount of interest. Okay, now the question number 11, it is why do lenders ask for collateral while lending? This collateral term we have discussed in the video while we were discussing the chapter. Okay, here you can see the answer. Lenders ask for collateral as security against loans. This collateral is a security. It's a security given by a borrower to the bank, to the lender. Okay, if the borrower fails to pay the loan, if he is not paying the money which is given by the bank as a credit, as a loan, the lender has a right to sell the asset or collateral to recover the payment. The bank or lender will do what he will do. He will sell the asset. It can be a car, it can be his house, it can be a piece of land, it can be gold, it can be any other asset. Okay, they can sell it and they can recover their payment. Collateral assets such as land, vehicle, etc. act as a security for the lender in case of the borrower defaults on repayment of the loan. It's for this reason that lenders ask for collateral while lending. Okay, this is what we discussed. Okay, these were the questions, short answer questions, and the fill-ups we discussed. And in the next video we will discuss the detailed these long answer type questions. Thank you very much.